Early-stage companies are generally unable to offer significant salaries to their employees, and therefore they try to attract talent through the issuance of equity compensation. There are a number of equity compensation structures that may fit the needs of the company, such as stock options, restricted stock, or profits interest plans.
Compensating employees and consultants with equity is a key incentive, but founders should be wary of giving away too much equity. Too often, founders give away chunks of shares when those shares are at their lowest value. This dilutes the founders right from the start, and that's before any additional outside investors arrive, resulting in significant additional dilution. You should think ahead about what key hires are needed in the short and long term, and determine how much equity you're willing to give. Stock option plans are also a way to align the interests of the company and its workers. Stock options vest over time, providing incentive for employees to remain with the company. When vested, employees can exercise options by buying the shares at the exercise price that was determined way back when the options were granted. As the value of the company increases, the value of the options increase as well.
The founders of the company should also iron out an equity compensation plan for their own efforts. Oftentimes, co-founders commit differing amounts of efforts and time into the new venture, and an agreement should be reached and memorialized as early as possible. Founders' equity is often papered as restricted stock, where the founders effectively earn their share of the entity over time for reaching certain milestones. These are generally called vesting terms. Restricted stock comes with terms that allow the entity to repurchase the shares that have not vested from the individual, as well as terms of forfeiture should the recipient quit or be terminated. From a tax perspective, the most important concept regarding restricted stock is what is called an 83B election. If a founder received 100 shares of restricted stock that will vest over time, and the value of that stock is $10 per share on the date of issuance, the total value that is received is $1,000. If the founder paid nothing for those shares, that $1,000 gets included on their personal income tax return today if they make that 83B election. The benefit to making the 83B election upon the receipt of the shares is that if the shares appreciate in value over time and you sell them in the future, the increase in value over time is taxed at the capital gains rate versus the ordinary income tax rate. Should the recipient not decide to make the 83B election, the recipient is required to pay tax on the increase in value as the shares vest over time at ordinary income tax rates. Because of the nuances related to equity compensation, we suggest that you reach out to your legal counsel or accounting firm for advice on how best to structure equity compensation plans.